So hello everybody, I'm back and I want to continue with chapter 13, and we're looking at the firm's capital structure. And what does capital structure mean? That means the type of capital it uses to to collect assets to invest in their projects. So if we look here, here's a simplified balance sheet, right? We're looking at a simplified balance sheet, and here's the debt capital, which is the long-term debt, and here is the equity capital, which is the stockholders' equity and the preferred stock and the common stock equity. So all these here make up the stockholders' equity: preferred stock, common stock, and retained earnings. So there's these three items here, right? So you'll notice here's the debt, here's the equity, and this is the total capital, which is the sum of the two, right? All right, so the cost of debt is basically it's lower than the cost of other forms of financing, because you take the interest that you pay the debt holders, the bond holders, and you write that off. So that lowers your cost. It's kind of like your mortgage, right? So that'll lower your cost. All right, so basically, lenders demand relatively lower returns because they take in the least risk, right? Bondholders are going to get paid first, right? In case the company goes belly up, the bondholders will get paid first, and they have this high. Again, here you see the higher priority of claim on the against any earnings or assets. So let me just highlight a couple of things here, if you don't mind. And bondholders are the lenders, and they have this higher priority of claim. They take the least risk because they get paid first, and the cost of debt is lower than the cost of other forms of financing. All right. And here's what I just mentioned, right? The tax deductibility of interest payments also lowers the cost of debt, similar to what people do with their mortgage, right? They write off the interest payments. All right, so I just wanted to make that point. And all right, so debt capital always has to be repaid, right? If someone loans you money, let's say bonds, you have to get your money back, right? Equity is technically it goes on forever and it's infinite in time unless the company bellies up. So like GE has a share of stock, right? And you bought a share of stock. Some people own GE stock for 100 years now, and it remains invested in the firm, right? There's no maturity date. Okay. So with regard to stock, there are two basic sources, right? Preferred, which gets paid first, and common stock. All right, and part of common stock is retained earnings. So I want to make something clear about retained earnings. Retained earnings simply means that instead of giving you the money you're owed from your earnings on the very bottom of the income statement, they keep it and invest it in the company. So Google doesn't pay dividends, right? So they retain the earnings. So if they don't pay any dividends and they retain the earnings, they're using it to grow the company. So when you buy a share of stock, please make sure that you see the whether or not it pays dividends. That's real important. So when it comes to claims, the claims of the common stockholders are riskier than those of other lenders. So cost of equity always exceeds the cost of debt, right? Because they're taking the most risk. They get paid last, the common stockholders, so they want more return. Always remember, more risk implies more return. Okay? Very good. All right, so one of the ratios we had looked at from Business 330, which you should go back and review, is the debt ratio, which is the total liabilities over the divided by the total assets, right? So the important point with this whole ratio is the higher this ratio is, the greater the relative amount of debt or financial leverage in the firm's capital structure, right? Debt will give you financial leverage. All right, the other point is a measure of the firm's ability to meet contractual payments associated with debt include the times interest earn ratio. This is basically how much interest you're paying out compared to your EBIT, right? And you can see that ratio here. Again, this goes back to, I believe, Chapter 3. So you may want to, you have the textbook, you can review that. All right, so here's all the debt ratios for different industries. Something you can just look at. It's not that important. And here's a personal finance example, right? And you basically, it's looking at your mortgage payment and your gross income. And if you have any questions, you can go over this and just email me about that. All right. So some of this is just blurb that they fill in here. All right, so the important point in this slide right here, and I want to make it very clear, is when you have debt, right, there's a tax benefit to issuing debt. And that tax benefit is that you write off the amount of interest you pay the bondholders. So this statement here, letting RD equal the before tax cost of debt and letting T equal the tax rate from Chapter 9, we have RI equal RD times 1 minus tax rate. So the after-tax cost of debt is right here, equal the before-tax cost of debt, 1 minus the tax rate. You're being subsidized, as it says here, by the government. Everyone see that? So it lowers. So when you buy a house, right, you can write off the interest, so the government subsidizes your tax rate. All right, so all right, so here's a probability of different sales for that previous example. You can see there's an example here about EBIT, right, and a 25% chance that sales will total 400, and a 50% chance that sales will total 600,000, and a 25% that they'll total 800,000. So the resulting EBITs are calculated here. So here's the sales that they tell you about and the different probabilities. And you subtract off the operating costs and variable costs, right? And basically, if you just do simple math here, 600 minus 500,000 is 100. There's the probabilities of your EBIT for different, and for these 3 different probabilities. All right, so here's their current capital structure. No debt, right? You see this. The current capital structure of Cook Company has no debt, and their common stock equity is 500,000, and their total capital assets equals 500,000 because obviously you add up 0 to 500,000, right? And this show, now we're looking at different debt ratios, right? See these different debt ratios? Here's no debt. Here's 500,000 in assets. None of that's debt. That's all equity, right? And here's the shares of common stock outstanding. It's $20 a share, right? So you divide that by 20. Let's go back and look at that, right? I think in the problem they said it was $20 a share somewhere. No? All right, maybe in the book they mentioned it's $20 a share. Well, you can see here they divide by 20,000. Oh, the $20 value represents the book value per share of common stock equity noted earlier. All right. And if we have different, now if you have a 10% debt ratio, 10% of total assets is 50,000, right? 10% of 500,000 is 50,000, which leaves you 450. Notice how these always add up to the $500,000 total, right? And you keep dividing by 20. And here is more of the same, different capital structures, right? Different debt ratios. And they go through this and they say, well, for debt ratio of 0 with these probabilities, here's your EBIT, right? Which is what we had, before. Where were we with that? From table 13.9, this is with the debt ratio of 0, and basically less interest. There's no interest, right? Because the debt is 0, so there's no interest here. So here's your net profit after taxes. I'm sorry, before taxes. So here is your taxes. And they go right through and they end up with the earnings per share here of 240 and 480. And here's your expected earnings per share, right? Because that's in the middle, right? You notice the expected earnings per share is right in the middle here, 240, right? And these items, you can standard deviation. I believe this is from chapter 6, how to calculate expected earnings per share or expected return, and how to do standard deviation. So, and also coefficient of variation. So you should go over that. And there's different tables with different debt ratios here. So if you have any questions on that, ask me. And so here's the final table with everything laid out for different debt ratios, with the expected earnings per share and the standard deviation and the coefficient of variations. And here they plot it as probability distributions, and they plot all the data that they showed you here. All right, so I will stop at this slide because there's things I want to talk about this slide later, and we're about 13 minutes into this presentation, and I will we'll discuss from here on later. All right, have a good Sunday, everybody.